Hi there everyone, and welcome to our March 2019 second edition of On Track. It's Friday the 12th of March as I record this. We've just had an announcement of an election, so that's going to fill our news for the next 5 weeks. I'll talk more about that as part of it. So thanks for watching our first edition. Thank you for the feedback. Just our quick general advice warning. Everything I say here is general advice. I take your circumstance into account when I'm doing your own individual reviews and portfolio adjustments. For anyone watching this who's not a client of McGregor Wealth Management, you're welcome to watch, but keep in mind it's designed for our clients. So what we're going to cover today, we're going to have a look at some of the news. We're going to, as always, put that into context, what that means for you, have a look at some market updates and current performances and put it all in perspective. And I'm going to spend a little while at the end talking about my view on the election. And just a warning, I'm not normally political at all, but I'm going to get a little bit political in this one. So apologies to anyone that I may offend there. So let's have a look at the news first. In Australia, the share market continued its strong rebound. I think the first quarter was the strongest quarter for about 8 years, but that of course followed one of the worst quarters for about 8 years, and that's pretty much evened out, as you'll see when we hit the performance numbers. The budget announced, absolutely a phantom budget. It may not be legislated if the coalition is not re-elected, which seems likely. I look at Sportsbet on the morning of the announcement. They have Labor at $1.16 to 1 and the coalition at $4.85. Quite staggering. I don't think it's that far apart myself. I'll talk more about that later. But yeah, on those numbers, it would be unlikely this budget will get implemented. The budget did offer tax cuts for everyone. Frydenberg and Morrison are pretty much trying to make sure they didn't offend anyone, had some goodies for pretty much everyone. Some of those deferred a few years. It did project a return to surplus. Very important that that's a projection, but it's probably the closest we've seen back to surplus in well over a decade. Big infrastructure spending, which is good news. The Australian economy has very different sectors that we go into different times of relying on. For a while, up to the GFC, we were very reliant on the mining boom. As the mining boom subsided, we're very reliant on a property and construction-led boom. As markets have eased off in Sydney and Melbourne, that's going to weaken the economy. And we're in a low-growth world, about 2.3% GDP growth at the moment. So good news, infrastructure spending, because that will help keep the economy going up. And the budget actually forecast growth getting up to about 3.5%. Some economists, and probably us as well, think that's probably a bit ambitious at the moment. I think there was over 4 or 5 years in the budget, but certainly the infrastructure spending will be a stimulus to growth. Election is on May the 18th, and at the end of this I will talk about the BS manifesto, and I'll share with you what the BS stands for. International news, also the rebound. It was the best quarter in 8 years for international shares. That of course did follow the worst quarter. So put them together, and if you'd been away for 6 months, you'd have said, portfolio is pretty much the same as it was. Announcement in the last couple of days, they're going to extend the amount of time Britain has to get its act together for Brexit. Whether that works or not, who knows? It's not going to have much impact on your portfolios. It's very interesting from a political and a world view, and it will be very interesting if you know anyone who's in UK businesses, but no real impact on portfolios to any major degree. It's interesting, in the US we've got an inverted yield curve. That just means short-term interest rates are lower than short-term interest rates are higher than long-term interest rates. That sometimes predicts a recession. So some people are saying we're going to have a recession coming, and a recession of course is 2 quarters of negative growth. You can have big recessions and you can have small recessions. The analysts are split on this one. Not all negative or inverse yield curves lead to recessions, but it's normally an indication. It's unlikely the US Federal Reserve, as we talked about last month, is likely to ease rates, and unless they're too late on that, it's yeah, my bet is we won't hit a recession over there, and I could easily be wrong on that. And watch this space. I don't think it's going to be, even if there was a recession, I don't think it will be a big one. I think in some ways the market already anticipated that, which was part of the December outcome. And keep in mind, the market is not the economy is not the market, and the market predicts ahead. Now, the balancing items on that is, there's a bit of easing of the US-China trade war. It looks like Trump is pretty keen to resolve it, particularly leading into an election year next year. China is stimulating their economy. That's good for world growth, including the US, as they resolve this, but also, more importantly, including Australia. European growth is extremely low, almost stagnant, but the European Bank expressed that they're open to stimulating, and that means through money printing, quantitative easing, which underwrites world growth and lessens the likelihood of a slowdown leading into a recession, both for the US and for Australia. So low growth, enough an environment for companies to make money, nothing scary, nothing to worry about, just normal cycles and in a slow growth world. To put into context, we rate the markets as either being in one of those 5 stages in the blue: FOMO, which happens rarely and happens only during the big booms; wall of worry, and we split wall of worry into 3 sections: expensive, fair and cheap; and fear. And of course, the key lesson always in this market context is busts, or the fear, always follows the boom, not the other way around. You never get major downturns, and by major I mean more than 20-25% without a boom. And in all the booms in Australia and most of the ones around the world, you see returns effectively double your investment in the 5 years in the lead up to that bust, and then drop by about 50%. So anyone who's a long-term investor, hardly affected. But anyway, that gives us the framework about which to rate where markets are at, which you'll see when I go through those. Aussie shares up 0.73% for the month, that is. 1 year performance sitting at 11%, 10 year at about 10.4. Keep in mind, we're at about exactly 10 years from the bottom of the market at the GFC. The bottom of the market was on March the 6th, 2009. We're slightly past that in this chart in the bottom right-hand corner, but it is off a very low base, those 10-year numbers. Ironically, it's about bang on average for the long term, and when we adjust the long term for current inflation, long-term historical return about 9.5%. People are predicting slightly lower than that in the next decade, but their record of prediction is pretty ordinary. I just go back to long-term history adjusted by current inflation, which will give me about that 9.5%, and certainly the market's delivered that over the last 10 years, over the last 3 years, and over the last 1 year. Not over the last 5 years, but that's a bit of a statistical aberration as well. If you look 5 years ago, and if you can see where my cursor's moving around, we're at a reasonably high point in the market. We then had a low, and we've come back. If you measured 4 years, we'd be high. If you measured 7 years, they'd be consistent. So there's a big care factor about where you measure returns from and what you compare them with. But Aussie shares doing okay, and we rate them as fair value. So that means neither good or bad time to buy, and if you're buying, it's reasonable to be buying. If you're selling, it's reasonable time to be selling, not necessarily the best time. US shares up 1.61% for the month. Now that's in our currency, and currency has a big impact on US shares, and I'll talk about that in the charts. Long-term historical, US at about 10%. For us, 7 years about 18.9. 1 year about 17.65. Now most of that, by the way, is currency. So as I talked about last month, that blue line is the impact the US dollar has on the last year. So you can see 17% return, but about half of that was effectively the fall in the Aussie dollar. In this little chart in the top of the bottom half there, you can see the Aussie dollar has fallen during the year, and that leads to better returns in anything that we own overseas, which underlines the importance of having international shares in your portfolio. The top right-hand corner shows 10 years worth of US results, and US shares have done tremendously well over the 10 years in Aussie dollars. It's interesting, the Aussie dollar marched all the way up over the last 10 years, right up to about $1.05, and then all the way down. to about 75, then up again a bit and down again. At the moment, we're slightly lower than the start of that 10-year period. So the US dollar has contributed a little bit to that 10 years, but a lot of it is just a good run on the US. Once again, off a very low base, being the bottom of the GFC. We rate the US share market as fair, slightly above fair, but not yet expensive, and certainly nothing to worry about. And we're certainly happy buying into markets at current levels. US small caps, an area that outperforms in the long run. Historically, we expect US small caps to deliver above other market performance. Historically, about 13%. You can see 10-year returns at about 16% at the moment. Once again, that is off that low base. 1 year, we've had a pullback, a nice healthy correction in US small caps that did run hard off the back of Trump's expansionary policies and good economic conditions in the US. And in the last months, we've seen US small caps come back in Australian dollar terms at about 3%. All healthy. We are back in US small caps in our active portfolios as we see that as fair value. And we did get back in after that correction. I'm very comfortable being in US small caps, which historically give very good performance. Global leaders, so this IOO, which is in your active portfolios, is the top 100 companies in the world. So that's where you get your exposure to companies like Facebook, Google, Apple, Amazon, the companies that make up, or pretty much the top 10 biggest companies in the world. Long-term, historically, you would expect those to grow at about 10% in today's inflationary environment, and we're seeing returns consistent with that. The top 100 companies were up 2.5% for the month, a very good result. All this points to why diversification is so important, because different sectors take over leading, and it's always nice to know you've got some winners in the portfolio on any month. Not that the monthly returns matter that much, which is why I show the long term and the 10-year stuff on the left-hand side and the monthly on the right-hand side. We view global leaders as fair value at the moment, and they're right in the middle of that long-term range. Emerging share markets had a bit better month, up about 1%, mainly on optimism that trade tensions, particularly in China and the US, will ease. China makes up a big chunk of emerging market shares. Long term, we do expect better than average returns from emerging markets. 3-year returns are good at the moment, but as you can see, the 1 year still negative, and the 1 month down. We do view emerging markets as cheap to fair value. All those numbers, by the way, were to the end of March. I'll amend the slides on that. They did say to the end of February. My apologies. They're all to the end of March. Here's the performance, and the Care quarterly newsletter will be out shortly, but I've got the performance numbers in that will make up that. And the top half here are the portfolios. So all of you will have one of those portfolios as your core portfolio. And it's quite interesting. 5-year performance, which was from that little bit of a spike, but it's pretty much bang on what we project. So inflation plus 6 or 7 for the high growth. So 9, 8, 6, 5, 4. So a nice orderly market. 3-year returns are looking better because they were measured from a low spot. And 1-year returns once again are about bang on long-term expectations. The portfolio is doing well. When we add in the enhanced returns, we get very similar results at the moment, so not much difference. So that's for the total Care solution, excluding the reserves. So for someone in a growth asset allocation over 1 and 3 years, about 10%. The reserves, of course, will bring that down to about 8, which is a fair trade-off for having the flexibility. But good returns in line with long-term expectations that we use in planning your future, and all the portfolios are sitting in the top quartile of their particular benchmarks over 3 years. Property, and this is from CoreLogic, different source than last month. They're slightly different to say Domain, but the numbers are similar. They show year on year, particularly Melbourne and Sydney, down around 10% Perth, so Darwin down about 6%, Perth down about 7%. The green markets that are up, Adelaide a little, Canberra 3%, Hobart 5%, Brisbane, down about 1%, but there's areas of Brisbane that are up and areas that are down. This is for whole cities, and there'll always be slightly different stories. I know from clients who are buying in Melbourne and Sydney at the moment, there's some extremely good buying to be had, and particularly for those that have got the patience and got cashed up, those markets will be absolutely fine in the long run. Not sure how much more they'll go down. I suspect not too much. We're seeing a slowdown. They're not down by as much in the last month. And units, similar story. Ironically, not down by as much in Melbourne. So Melbourne units only down 3% in the last year compared to 10% for houses. And that was because units hadn't gone up as much in Melbourne. So still some very good buying in some of the inner suburbs of Melbourne, suburbs like Richmond, Collingwood, which are very much in demand, and their population is growing massively. Still in Melbourne, both natural growth from people moving to Melbourne, but also international growth. Just a quick reminder of how much these numbers have grown in the last 15 or 16 years. So anyone who's held property over that time in reasonable areas has done incredibly well, as they will if they hold property for another 15 years, most likely. From Heron Todd White, the property clock, always interesting. The areas in orange are the ones where they've changed their view in the last month, so it's quite interesting. And this is for houses. They have Brisbane at about the start of a recovery stage, and Brisbane is much better value than, say, Sydney or Melbourne, and it was held back for a while due to oversupply, mainly in the unit market. But certainly Brisbane has nice upside potential at the moment. According to Heron Todd White, and that's an opinion that I share, we're very comfortable with most of southeast Queensland, but a bit of care on the Gold Coast in particular. It's had a good run. So you can still see Melbourne and Sydney declining. So Heron Todd White hasn't called them at the bottom of the market yet, but no doubt that will happen in the next year or two. Now, keep in mind, markets can stay at the bottom for long periods of time. And they can literally stay at the bottom of the market for up to a decade before they recover and start a rapid climb. And these are guides, the property clock. I've put in this month the unit property clock, which is quite different. So we noted Brisbane was 7 o'clock or start of recovery in the housing market, but in the unit market, it's still approaching the bottom of the market because we do have that decline due to the massive amount of units that were built over the last 5 years, which led to an oversupply, which led to a price decline. Not dramatic price decline, there's still tremendous value there, and that unit oversupply is clearing, which will lead to those becoming reasonable value and good investments again. And put that all in perspective of what that means to you. Steady as she goes. You're going to hear me say this a lot, as you always have. No reasons to be either panicky or opportunistic at the moment. Stick with the plan. It's a reasonable time to be buying or selling, particularly in share markets. In property, reasonable time to be buying in southeast Queensland. It's not a bad time to be selling where that fits your plan, particularly for those retired looking to offload properties as part of their strategies. But it's neither. We're not in a boom, we're not in a bust for most of those markets. So for your portfolios, we're right in the middle of what we would call fair values. So there may be better times to buy or sell. We never know when they're coming. When we look at the rest of the year, we would expect pretty normal low growth in line with last year's returns. It's funny, the last 12 months was almost bang on our long-term averages. That's pretty rare. We'll normally be above or below. The averages are a result of all the different returns. But no, the last year's almost bang on what we'd expect. So continue to review. As always, we do that every time we sit down with you, or if your circumstances change. And as always, yell out if your circumstances do change, or if you have any concerns or worries about your setup. So just reinforcing that process before I get along and talk about the election. Goals first. portfolio designed to meet those goals always based on your life and who and what's important to you and the important areas of your life. Take a long-term view, it absolutely works. Anyone who has held their shares from the bottom of the GFC, being that international and Australian shares, has had returns of about 11%. Now for the accumulators, that's people that are still growing their wealth, that means over that years we've had, so a 10% return will double your investment in 7 years, a 7% return will double it in 10 years. That's just using the rule of 72, where you divide a return into 72 to find out how long it will take to double. So a 12% return, like we'd had in international shares, will double in 6 years. So where we've seen those strong returns in the last 10 years from the bottom of the GFC, that's meant, for portfolios that are being reinvested, well over a double, and actually closer to 2 doubles. For those who are drawing income, so if you're drawing 5%, you take 5% off those returns, so at about 10%, that still leads to 5, which means the portfolios are well and truly up. And we have a lot of our retired clients that have been long-term clients commenting at the moment that no matter what they're spending at the moment, their portfolios are still growing at the same time, which is great. So diversification, as always, super critical, and your portfolios are massively diversified, which takes away the risk of any one company, any one sector, any one market having a really bad impact on your portfolios. We do use index funds, which have a low cost for most growth markets. That has given us very good results. We do provide some protection against short-term volatility through our reserves, and by dollar cost averaging for those still growing their portfolios, and rebalancing regularly both within the portfolio, which the investment committee does, but also when we sit down with you by topping up reserves and rebalancing your portfolios when you add to your portfolios or withdraw from those. So that's the process. I want to talk now about the election. Now, I'm going to start with the photo in a minute. And I don't know if you've heard of that game called Whack-A-Mole, where you sit there with a hammer and there's about 10 circles, and these moles put their head up randomly and you've got to try and hit it before it pulls back down. I feel a bit like this at the moment, that our friend Mr. Shorten is trying to whack anyone who's trying to get ahead. You put your head up, if you dare and try and aspire to be financially independent, he's going to whack you. And I'm going to show you 12 ways he's trying to whack people who try and get ahead. I have spent the last 20 years of my life helping people to get ahead, and pretty much anyone, whether it's young people aspiring to buy properties, to buy assets that are going to go up in value, or whether it's retirees, they're under attack from what I'm calling the BS manifesto. The BS manifesto is dirty dozen. So have a think about what BS might stand for. And it stands for a couple of things. It actually stands for Bill Shorten. It actually stands for Bowen and Shorten. Bowen being the shadow treasurer and the architect of the co-architect of all these things with Bill Shorten. And you know what else BS stands for. So here's the dirty dozen, 12 things they're proposing, and they're in a rush to do them too. There's talk that if they get in May 18th, they will rush to get stuff legislated before the Senate actually changes over on July 1. This is only a half Senate election, so only half the Senate will change over, and they don't change over till June 30. So if Labor gets in, they may still hold a majority in the Senate from this period. So it's a bit of a dirty trick as well, because they won't have a true mandate unless they do get a majority in both houses. That will be scary. Be very careful about any protest votes you may feel like posting against either the coalition or Labor, because I know there are many of you, and like me, frustrated by both parties. It's tempting to throw a protest vote and vote for the Greens or for Palmer or one of the independents, but that will result in potentially some bad things. A vote for the Greens is a vote for Labor and will give them control. The Greens have no economic realism whatsoever, nothing. They vote for much higher taxes than Shorten. They literally want to tax everything so they can implement fairly radical agendas. Anyway, enough of that. Let's have a look at the dirty dozen. A 50% increase in capital gains tax going forward, more for some people, by halving the discount. That's going to affect everyone who buys any new assets from probably either July 1 of this year or January 1 of next year, depending on how they implement. So it doesn't affect your current assets, but for your kids and for anyone who's still got plans to buy more assets, that's going to increase your capital gains tax going forward by 50%. It's a pretty big increase. Elimination of negative gearing except for new properties. So once again, this takes away the incentive for young people to lose some money, to make some investments. And where most people that I've met over the years who are financially independent have bought a negatively geared property or two over the years, and people who are financially independent at retirement save the government $1 million at least by not having to pay pensions and other support. So this taking away the incentive for people to do things that will lead them to be financially independent is kind of false economy. A typical negatively geared property at the moment might have about $7,000 negative with all the things taken into account. So that maybe is going to be about a $3,000 tax break. And it's only for the few years until the rents go up. So that incentive is kind of crazy to take away when that's going to lead to the government, future government saving millions of dollars. The third one is removal of personal contributions. So the coalition brought in a couple of budgets ago the ability to make personal contributions no matter whether you're employed or self-employed. So as well as your employer making their contributions and as well as self-employed people being able to make contributions, this allowed for anyone to make a contribution and gain a tax deduction. They want to take that away. No good reason whatsoever. Removal of the $25,000 catch-up contribution. So also when those personal contributions were announced, we now have a very low rate of that you can claim tax deductions for super contributions of $25,000. The government recognised that most people during particularly the expensive years of child rearing and school fees and all of that stuff, it's very hard to put in that maximum amount of money. So they provided that people would be able to catch up those contributions. Shorten wants to get rid of that, quite mean-spirited. The non-concessional cap, which is currently $100,000, which is the amount of money you can put into super without claiming a tax deduction, proposing to drop that to $75,000. Anyone who's had a family trust, which will pretty much be anyone that's ever had a business or has set themselves up to provide legacies for their family. At the moment, family trusts aren't taxed directly unless you leave income in there. The income is distributed to beneficiaries and taxed in the hands of beneficiaries at their marginal tax rate. The BS manifesto wants to tax that at 30%. And now that's going to include farmers, that's going to include tradie businesses, that includes so many people. I think this will be incredibly unpopular, and hopefully there's a lot of noise made about this in the next 5 weeks. Extra super tax for those earning earning above 200,000. So at the moment, if you earn taxable income of more than 250,000, you are slugged an extra 15% tax on your super contributions. That's the $25,000 of tax deductible super contributions. Shorten's proposing to drop that limit to 200,000. You've heard lots about this one. It's for retirees. They're talking about taking away the franking credit refunds. We've talked to most of our clients on this. For anyone who's in a self-managed super fund, we can very easily show you how to restructure that to keep your franking credits, which I mean the only people affected will be particularly those older who've got their shares outside of super, who didn't have as much of their stuff in super, so quite unreasonable there as well, particularly because they're not high income earners. So bad policy, in my opinion, and another whack. Removal of the work test, the government did propose, and BS blocked it. The ability for people to make super contributions up to age 75 without meeting a work test, and they've indicated they're going to continue to block that. In the latest budget, Josh Frydenberg announced that over the next few years, I think it's about 2024 actually, they'll increase the top tax bracket to 200,000. Now that is just handing back bracket creep. It's been at 180,000 for a long time, and with inflation, people have crept into that bracket with just inflationary increases. So the removal of bracket creep by pushing that out there The BS brigade has said, no, we're not going to do that, which means they're just against handing back bracket creep. If either side of politics had any guts, they would be indexing all the tax brackets so that bracket creep didn't take away our taxes as inflation pushed us up. So number 11, they're talking about removing limited recourse borrowing arrangements. That's the ability for super funds to set up with some very specific rules, the ability to borrow to buy property. Now, there's been a few cowboys out there selling inappropriate solutions in here, but much better to get rid of them by imposing penalties than get rid of this, which very good opportunity, particularly for young people, once again trying to get ahead. But no, don't you dare try and get ahead doing anything other than having a normal job, putting your money into an industry super fund, because if you try and get ahead by doing absolutely anything else, from business to property to share investing, you're going to get whacked by the dirty dozen. And lastly, increasing employer contributions from 9.5% to 12.5%. Good if you're an employee, but for the many people who are employers, this is just an extra cost. An extra cost leads to less jobs and less wage growth. So that's the 12 ways that Shorten's going to whack anyone who dares to try and get ahead. As I said at the start of this, I'm not overly political. I think some of the best initiatives we've had in this country have come from Labor, particularly the Hawke-Keating years, and I was very critical during Howard's years of their inability to use our most prosperous era to pay off debt, with all the middle class welfare that went on during the Howard years. So very political. So both sides do some good and both sides occasionally do some bad. But this is the worst I've seen for anyone trying to get ahead. So as you're talking to people, I'm going to share these last two slides on some of our social media. Please share it. And if you're talking to your kids, grandkids, all this stuff affects them. It's not just attacking retirees who are so-called wealthy. This affects young people who want to get ahead, anyone who wants to get ahead. I'm going to leave it at that. I'm going to wish you a happy next month, or till next time I see you. The election's going to be fascinating. Let's hope we don't hand absolute power to Labor so that all of these things aren't implemented. Good luck. I'll talk to you soon.